QE for property investors is really important. But when QE is at record levels that have never been seen before, and the approach has very discreetly been changed by the government, as property investors, you must understand what's going on. But don't worry, by the end of this episode, you'll understand and you'll know how to take advantage of it.
Welcome to the Property Podcast, where every Thursday morning property investors come to be informed and inspired. Now, you'll have heard of QE, I'm sure, and we've talked about it on the podcast in the past. But if you just kind of skipped over it and not thought about it too much, I do not blame you at all. It sounds really boring. It is really complicated. But it also is extremely important. When you understand QE, a lot of what's happened over the last decade will make a lot more sense, and will also give you a big clue about what's to come in the next decade. So this isn't going to be the most easy listening episode we've ever done, but it is well worth paying attention. And stick around to the end, because in Hub Extra, we've got a resource that we've both started using recently that's given us a big productivity upgrade.
A major news story in the world of property this week comes from the BBC, and the government announced that £3.5 billion was being allocated to help people out who are suffering from the cladding crisis. Now, we've talked about this before a few times on the podcast, where multiple people are trapped. The BBC article that we've picked out this week, the headline for it reads, "Cladding extra £3.5 billion for unsafe buildings. Too little, too late." It's amazing when £3.5 billion is too little, Rob.
Yeah, I think it maybe is too little, but the issue that people really seem to have with it is who it helps and who it doesn't. So the background to this, of course, is that post-Grenfell, there's been a lot more focus on fire safety, especially around a particular type of cladding, but it's gone broader than that now as well. And this has meant that while this is going on and there's potentially large bills looming to put things right, lots of owners of apartments have been unable to sell or remortgage because lenders aren't willing to take the risk, and understandably, even if buyers didn't need a mortgage, they wouldn't be particularly keen on it either. So they have been left in limbo. There's been a lot of pressure on the government to do something about it and not just leave leaseholders to pick up the bill. That is where this £3.5 billion has come from. The problem with it, people have been saying this week, is that it's a bit arbitrary in who it helps and who it doesn't. So they've said that this fund is available to buildings over 18 metres high. So if you're in a real high rise, then it'll be rectified at no cost to the owners. For buildings under that height that still need work doing, then it's not going to help them at all, but they have talked about making low-cost loans available. So it's hard to be the government, right? Because whenever you do anything, even if someone agrees with it, they always say, oh, well, it doesn't go far enough. But in this case, it does seem a bit arbitrary. I get that they feel like they can't just throw unlimited amounts of taxpayers' money at this. And this news has certainly made some people happier, but it hasn't solved it completely. And I don't know if they'll find more money from somewhere or put another scheme in place, but I do have a feeling this isn't going to be the end of this story.
And just a quick reminder that if you are also following AOB, Any Other Business, our brand new podcast, it's on a separate feed, so go search for that if you haven't already. If you are following along, you may have noticed that we have changed days, and that's because we have moved from Friday to Monday. We are now kicking off your working week, so the podcast will go live in your feed every Monday. But if you want it sooner, don't worry, we will get the video out on a Sunday. So every Monday in your podcast feed, and if you want an early sneak peek of what we've done, then check out YouTube on a Sunday. So why dedicate a whole episode to QE, quantitative easing? Because let's face it, it doesn't sound that sexy. But as a property investor, it's so important that you understand this, because it's going to impact you, all your investments, and your future wealth or lack of it if you don't understand it. It's that important. For us, it's as important that you understand QE as much as it is to understand leverage or the impact of inflation. This is one of the core concepts to long-term property investing that you need to understand. But it's a bit overwhelming. It's hard to understand. Rob and I, off air, will go into deep discussion on the impacts of it because nobody knows for certain. But there are some core principles that you should understand and you need to know about, because QE in 2020 went to record levels. But before we get into what happened in 2020, how it's different this time, and the impact it's going to have on you as a property investor. Let's do a quick recap of exactly what is QE.
Okay, so QE is carried out by the Bank of England. And so we need to start by understanding what the Bank of England are actually trying to do. So their job, as given to them by government, is to produce inflation of about 2% per year. The government wants mild inflation, and the Bank of England has to try and make that happen. And it does that by controlling the money supply. The greater the supply of money, the theory goes, the more prices go up. And this is a basic supply and demand mechanism. If you imagine that you've got the same amount of stuff in the world, goods and services that people want to buy, and then you increase the amount of money available to buy it, you'd expect the people with the money to bid up the prices of the goods and services that are for sale. Now, the Bank of England doesn't actually produce the money directly for the most part. It encourages banks to make loans, and it's these loans that increase the amount of money in the economy. It does this by setting the base rate that banks can borrow at, and the lower the base rate, the cheaper it is for banks to lend. Cheaper loans, of course, mean that more people are going to want to take out loans. If you could take out a loan for yourself or for your business at an interest rate of 2%, you'd be far more likely to take out a bigger loan than you would if it was costing you 5%. So the Bank of England can, by a very indirect route, manipulate the amount of demand there is for money by setting the price of money. Now, all this is working very well until the 2008 financial crash. As a result of that crash, the economy contracted. People were defaulting on their loans, no one wanted to take out new loans, and therefore the amount of demand for money in the economy was falling. The Bank of England cut the base rate from around 5%, where it was before, all the way down to 0.5% to try to get the economy going again. But still, it didn't create enough inflation because nobody wanted to borrow, and the banks didn't really want to lend because they just experienced so many of their loans defaulting. So this interest rate mechanism that had worked in the past suddenly didn't work anymore. It couldn't go any lower, and they still weren't getting the result they needed. So it was time for a new tool, and that tool was QE.
So how does this work practically? Well, what happens is the bank will create, effectively, money. It's often called printing money, but nothing is printed, but it helps people understand it. But money is created. And then the Bank of England will take that money that's been created and buy bonds. And those bonds will then sit on the balance sheet, and those bonds are removed from the market. We'll talk about the consequence of this action shortly, because this does have a consequence, as I'm sure you can imagine. But it really is as simple as money being created and government bonds being purchased. So how much of this purchasing has been going on? Well, quite a bit. So in late 2008, we had financial Armageddon. So in 2009, the Bank of England created 200 billion or 200 billion of QE to purchase government bonds, a lot of money. But in 2012, the world was still a wobbly place. There was a lot of concern around Europe and what was going on there and whether the euro could survive. So in 2012, the Bank of England engaged in quantitative easing again, and at this time for £175 billion. So it went quiet then for a few years, and the Bank of England perceived that to be enough. But then in 2016, Brexit was announced, and again that created some uncertainty. So the Bank of England was quick to act and did another round of QE, this time to 70 billion. And that brings us all the way up to 2020. In 2020, it was just taken to a whole nother level, and in this round of QE, it was £450 billion. Not in total. That was just 2020. 450 billion, which is more than all the other previous rounds of QE added up together, just in 1 year. So you can see why we want to cover QE again, because what's gone before has just been a warm-up to what's happened in 2020.
So we've got some big numbers, and we've got a seemingly quite arcane mechanism with bonds being bought by the Bank of England. What does it all mean? What are the effects of QE? So first of all, the money supply has increased. That was the whole point of the exercise. Remember, the Bank of England just created the money to buy the bond out of nothing. It didn't print it, but it effectively just typed it into a spreadsheet somewhere, and suddenly this money comes into existence. So previously you had a bond, now you've got the money and the bond. So there's more money in the economy than there was before. This should produce inflation, because that is the stated point of the exercise. Has it been inflationary? That's a more complicated question than it first appears, and we're going to come to that in just a minute. The second effect is that the price of government bonds rises, and therefore the yields on those bonds falls. That is simple supply and demand. You've got the same amount of bonds and you've got a new buyer in town, the Bank of England, which is going to push the prices up and therefore the yields down. A side effect of this is that it becomes cheaper for the government to borrow. That's because yields are now lower, but also because it doesn't have to pay interest on the bonds that used to be owned by someone else, but are now owned by the Bank of England. Technically it does, but they're just paying the interest to themselves, so really they don't. And the fourth effect, which really is the big one for our purposes, is that the price of other assets rises. That happens for a couple of reasons. Firstly, all the institutions who previously owned the bonds, which they sold to the Bank of England, now have got cash instead, and they need to deploy that cash to buy something. They could use it to buy government bonds again, they could use it to buy corporate bonds or shares or property or anything else, and that applies upward pressure to asset prices. The other reason is that the price of other assets is to a large extent determined by the yields on government bonds. The fourth effect, and this is the really important one for our purposes, is that the price of other assets rises. There are a couple of mechanisms by which that happens, which we don't need to get into right now, but as well as the price of bonds increasing as a result of QE, the prices of other assets increases as well. And if you look, Rob, at what's happened to asset prices since 2009, when QE started, you can really see this playing out.
Yes, and it's important to remember that QE and the effects of it aren't instant. So what's just happened, the £450 billion of QE, isn't reflected on these numbers. This is the previous rounds of QE that have created this impact. So since 2009, the FTSE all-share market has almost doubled. Now, of course, the impact isn't solely down to QE, but it does play a major part. So since 2009, the FTSE all-share market has almost doubled. House prices are up 63%, gilts are up 80%, and gold is up 180%. Now remember, before you all rush to gold doesn't give you a return and you can't leverage against it. So the total return and the benefit that property investors got from that 63% rise is actually much more. But the point is that generally asset classes across the board all experienced really strong growth. But what's interesting is when you look at consumer prices, the costs of day-to-day goods and services, that's just gone up by 37%, which equates to 2.9% each year. So actually, while lots of people say QE will create inflation, actually, in reality, it hasn't. Now, Rob's already said that the effect of QE should be inflationary, but now we're saying that to consumer prices, it hasn't been, only to asset prices. And this is because of how QE is utilised. But many people, when QE was introduced, were screaming from the hilltops that we were going to go into a super high inflationary period, but that didn't happen. Now, this is where you can stray into modern monetary theory, MMT as it's sometimes called, which is a whole other area of economics that is really interesting, but not something we're going to cover today. But we may come back to that in another podcast in the future. But for now, all we need to know is that previous rounds of QE have caused asset prices to go up, consumer prices to grow in line close to expectations, and the 450 billion, the record amount that was introduced last year, hasn't touched any of this so far. So besides it being a record amount of money created, what else is different about QE in 2020?
Well, this is where things get really interesting. Because there's this point you just made, Rob, of why has there been asset price inflation, but not consumer price inflation? And the answer to that is likely to be in terms of where the money went. So because the new money that was created ended up going to financial institutions, those financial institutions then went out and bought assets, and therefore asset prices have inflated. But that money hasn't had much contact with the real economy, people who are actually producing and spending. That's why consumer prices aren't up by anything like as much. However, the mechanism for QE in 2020 is subtly different.
And it really is subtly different, very subtle, because you can barely find any mention of this on the internet. And actually, when Rob D said to me the other week, this is different this time, I disagreed. But I've since eaten humble pie because it is different. And this is why this podcast is so important, because this just is not being reported. But the difference is huge.
Yeah, conspiracy theory time. It could be because no one really wants you to think about this too deeply. Because when you think about and understand what I'm about to run through, it is a little bit shocking. So it all comes down to what the government is doing in terms of its spending while this QE is going on. So if we go back and look at the 200 billion of QE in 2009, the first time this happened, government spending the following year increased by 40 billion. And 40 billion sounds like a lot, but it's a lot less than the 200 billion. And given that it was in response to the financial crisis, it actually wasn't that much. Then we'll go to 2012, which is where there was another round of QE, this time 175 billion. In the following year, government spending only increased by 20 billion, so a tiny fraction, because if you remember at this time, the government was trying to pursue a policy of austerity. So this money was being created, but this money wasn't being used to fund government spending. It was going elsewhere. However, in 2020, we had the pandemic. The government suddenly needed to find a lot of money to pay for furlough, the job retention scheme, loans to businesses, more spending on health, benefits increases, all that kind of thing. It suddenly had this extra funding need. And this extra funding need in 2020 was £485 billion. That is the amount of new government bonds that they issued. QE in 2020 was 450 billion. So the amount of debt that the UK government issued is almost exactly matched by the amount of bonds that the Bank of England bought. And if you go a bit more granular and look at the amount of money that the government required month to month, and then you look at the amount of QE that happened in that month, they track each other almost exactly. So it's a subtle difference, but it's an important one. In previous rounds of QE, bonds were being taken out of the market. That was the net effect. The Bank of England was buying up bonds that already existed and taking them out of the market. In 2020, for every bond that the Bank of England bought, a new one was being created. It takes a bit of getting your head around, but effectively, the effect is exactly the same as if the Bank of England had just printed the money and given it to the government. There are various legal and practical reasons why it ends up going through third parties, but the end result is the same. The Bank of England has printed the money that the government needs. So even though what happened in 2020 has the same name as what happened previously, I don't think it deserves to have the same name, because what's actually being done, the reason it's being done for, and the likely effects of it are completely different.
They are so different. In its simplest form, for you to understand this, and it may not technically be correct, but in its simplest form, the government's just created 450 billion to spend on itself. But not itself, really, on you. Because this money has been spent on furlough, job retention schemes, loans, more health spending, benefits increases, universal credit, for example, the temporary rise there. There's loads. They've been spending this money. And this is very different to what's gone before. And this was kind of the complaint, and understandably so, of QE in the past, is that it just went into buying bonds. No new bonds were created, so the yields on the bonds were reduced, asset prices went up, and really the wealthy, or the wealthy middle classes and above, benefited because they owned assets, and the government and the Bank of England hoped that there'd be some trickle-down effect where people without assets would also benefit. But here it's far more direct to the end consumer, the general public. And this is actually a lot closer to what America has always done. America has operated in this way. They've kind of done a pick and mix of QE spending. When they've created money, they've sometimes bought bonds, but they've also bailed out mortgage markets, given money directly to people for them to spend. So it's not a new concept, it's just new for the UK. So the chances are now that before, inflation only occurred in asset prices. But this time around, inflation will also end up in asset prices, but also consumer prices. So the costs of your goods and services are likely to increase as well. And think about it, it's easy to understand how this could happen. If you have been furloughed, you've taken advantage of that government money that's been given to you, you might not be earning your full wage, but you're also not travelling, you can't eat out at the moment, you can't go out socialising, you know the score. You can't do much at the moment. It's hard to spend your money. So there are a lot of people who are building up a cash pot, savings. And when the shackles are off and we can all go out again, some people will retain those savings, but most will spend it. And that spending could then cause inflation. So they'll spend it on holidays, new TVs, home improvements, but also assets, stocks, gold, and property. So it's easy to see now how this time around it could create inflation across the board. Now, all this money sloshing around fits very nicely onto the 18-year property cycle and onto the Ray Dalio's long-term debt cycle that he talks about as well. Now, we'll link in the show notes to our episodes that we've done previously on the 18-year property cycle, a course we've done on the 18-year property cycle, and a YouTube video we put together on Ray Dalio's long-term debt cycle and New World Order. It sounds very dramatic, New World Order, but actually it's just the shifting of power from America to potentially China, but all driven by money. Don't worry if that all sounds complicated. We've done our very best in those courses and videos to make it digestible. So this is one of those weeks where you do want to go to the show notes, go to propertyhub.net, go to the podcast section, and you'll find the show notes for this episode. And when you go there, you'll get all the links to all these resources we just mentioned. So we've had record levels of QE, more than everything else put together before. We've got QE that's different this time. And we've got QE that will possibly have an inflationary impact, not just on asset prices, but also on consumer goods as well. So you know what's likely to happen now, but what can you do about it? And as property investors, take advantage of it.
Well, this is the big question. I hope this episode has made clear why QE is something that you need to be paying attention to. Because if you don't, you're just going to misinterpret and misunderstand a lot of what you see and hear around you. So, for example, when you hear people saying, oh, well, taxes are going to have to go up to pay for all of this. Well, they're not. A modern monetary theorist would say that if inflation kicks off, then you will have to tax to take money back out of the economy. But if QE didn't exist, we would not have had all this stimulus. If we had to pay out of pocket for all the government measures that took place in 2020, there's no way that you could pay out of pocket for all the measures that took place in 2020. And there's no pressing need for the government to raise taxes to get the money back again, because doing that would be counterproductive to the recovery it's trying to bring about. They probably will raise taxes in certain areas, but that'll be more signalling than anything else. That's just one example of why, if you don't understand QE and what's happening and what it means, you're going to be led to the wrong conclusions. In terms of actions to take, though, well, the answer is that what you should do is the same thing that we've been saying you should do for 8 years now, which is to buy assets. Ideally, you would have wanted to be an existing holder of assets, because as we've seen, partially as a result of QE over the last decade, owners of assets have been massive beneficiaries of this. But failing that, the best thing you can do is to buy assets now. Why? Because, well, there's this extra 450 billion to feed through. And even though the mechanism is a bit different this time, a lot of that is still likely to end up in asset prices. The other reason is that if this new round of QE does end up in creating more inflation in consumer prices, then the value of any cash you hold is going to be eroded. This again is something that we've talked about repeatedly on the podcast over the years, and this is just a more exaggerated version of the same thing. If we end up in a situation where there's general inflation, then holding cash is the worst thing you can do, and taking out debt is a pretty good thing to do, because the real value of your debt is going to be inflated away. And if we continue to get asset price inflation, well, you just win twice over.
So another episode you'll find in our show notes is our podcasts on inflation, because inflation really plays an important part into either diminishing or aiding your wealth creation. But in summary, if you buy assets with debt, then you can take advantage of what's played out. This is not to say it's fair or right, but this is how it is. You haven't created this environment. You haven't created this situation. But what you can do is share this podcast so people can understand what's about to happen and let people make their own choices. But people should buy assets, and when possible, buy them with debt. Because if asset prices rise and inflation hits in and you're in that position, you're in a position to win.
All right, it's that part of the show where we love to share your success. If you've had a win, whether it's big or small, we'd love to hear about it so we can share it with everyone else. You can do it on the Property Hub forum, you can do it via our social channels, or we particularly like it when you leave it in the form of a podcast review like John did. John says, thanks so much for your podcast. I've been listening for the last 18 months following a recommendation from a mate. I've worked on my strategy and set clear goals. And after months of saving, I finally took the plunge at the beginning of the year and put in an offer on my first buy-to-let, a 2-bed in Nottingham. Everything got stalled because of COVID, and I had a few wobbles about whether now was the right time to be investing. But your podcast kept me motivated and up to date. I finally exchanged in November and managed to secure a tenant before completion. And now I'm saving for my next one and still listening to the podcast. Well, John, that is absolutely brilliant. 2020, not an easy year psychologically or practically for that matter to be getting started in. So if you've managed to do that in a year like that, I'm sure you will go on to do wonderful things. Well done.
It's time for Hub Extra, where we just want to bang in a little bit more value before you leave us. Oh, why does this have to end? Well, let's end on a high. Property Hub Extra this week is a tool that we've both been utilising. So because of lockdown, I've changed my computer setup. I previously worked on an iPad Pro because I travelled around a lot. Travel, not been a thing really recently. So working every day, all day on an iPad Pro while sat at a desk wasn't the ideal setup. So over the holidays, I invested in a widescreen monitor and a desktop setup. And wow, how I'd wish I'd done this sooner. The widescreen is the resource this week because the widescreen monitor really ups your productivity levels. I've seen a lot of YouTubers have widescreens, and I thought it was just kind of a statement, but actually the productivity gains that you get from having a widescreen are huge. And Rob, I managed to sell you on the idea a week or two later, and you've jumped on board and got yourself the same widescreen.
Yeah, you're very persuasive. But you were not wrong. I had a feeling it would be, but because usually I travel a fair bit, I just stick with my laptop. And when I was at home, I didn't want to get a big monitor because then I thought I'd miss it when I was away. And now I'm worried that I won't go away even when I can because I won't want to leave my monitor. It's made such a difference. Just being able to have two documents up side by side, or to have Slack, which is the chat tool we use internally, up alongside what I'm working on. It has been a big productivity upgrade and it's just made it so much more pleasurable as well. So don't wait as long as we did. It really is worth investing in something that's going to make you more productive and make your working day better.
So that's us done for another week. Lots of homework in the show notes this week, so make sure you go and check those out. We'll be back, of course, this time next week with the Property Podcast. And of course, with Ask Rob and Rob on Tuesday. So lots to keep you busy with, all the links in the show notes and the upcoming episodes. So we'll let you get on with it. Take care, everyone. Have fun. Bye-bye.
Bye-bye.